For the first time ever, Wall Street's name has vanished from Canadian dollar bonds. In both Ontario's $2 billion bond offering and Alberta's $4 billion mega tender, not a single American bank logo was present. The port cranes may still be moving, but warning signs are flashing along Bay Street. The decades-old balance of North American finance is beginning to fracture, with London and Frankfurt stepping in to fill the void. Meanwhile, Canada's federal cabinet is encouraging companies to expand into Asian markets. Tariffs with the US are no longer just about trade. They're now dividing the flow of capital itself. Can global supply chains weather this shift? Or has the US dollar empire suffered a wound it can't recover from? To explore these questions further, be sure to subscribe and turn on notifications. This story has major implications for your wallet and the wider global market. Ontario's $2 billion 10-year US bond issue in early June marked a turning point in Canada-US financial relations. The bonds sold out quickly, and pricing wasn't even a hot topic. But for the first time, American banks were absent from the table. Instead, firms like Barclays, RBC, CIBC, and Scotiabank led the charge. There was no champagne or celebration, just quiet handshakes, some nervous glances, and a collective recognition of a new reality. The trade tensions with Washington had finally spilled into finance. At first, many dismissed the shift as a temporary political gesture. But on Bay Street, the silence following the auction spoke volumes. Despite the fact that the bonds were still denominated in US dollars, and the world's liquidity pool remains mostly on the American side, Canada had begun building its own financial path. By mid-March, Alberta had gone even further, excluding Bank of America from a €4 billion issuance. Inside Calgary's skyscrapers, risk committee members reviewed projections while gazing over snow-capped peaks, making decisions with the assumption that Europe would fill the gap. This shift sparked widespread repricing of risk across Canadian bond desks. Banks updated collateral calls on lower-rated loans. Asset managers expanded their euro-dollar hedging positions. On a more personal level, Elaine, a pension fund manager based in Edmonton, canceled her usual trips to Washington. This quarter, her market pulse check took place over lunch with EU regulators in Frankfurt. Meanwhile, a London-based broker processed a Toronto to London swap with barely a second thought. On the ground, financial uncertainty replaced any initial surprise. As tremors ran through credit markets, Ottawa began quietly pushing new export strategies. Export Development Canada dusted off market plans for Southeast Asia. Strategic warehouse plots near Brazil's Santos port were flagged as critical. At a Montreal logistics fair, a surprising number of Vietnamese brokers showed up, not to ask about access to US markets, but to inquire about Canadian freight insurance terms that didn't rely on US bank guarantees. Behind closed doors in Washington, concern began to grow. Canadian bond commissions had long been a quiet but steady profit source for Wall Street. Their disappearance didn't make the news, but by year-end, the missing figures in premium tables told a painful story. At JP Morgan, when senior bankers found they could no longer pencil in Canadian lines to their new tender schedules, a single question echoed in the halls. If you remove one small stone, will the whole wall shake? Ontario's financial distancing wasn't limited to bonds. A key regulation added in April restricted provincial contracts from being awarded to US suppliers unless no domestic or allied supplier was available. That meant every component, from steel rivets to IT consulting, had to be sourced first from within Canada, then from partners, and only finally from the US. So, when a Stockholm-based tech firm submitted a bid for a hospital's procurement platform, replacing a Seattle competitor, the manager hesitated. But after reviewing currency trends and value, the Scandinavian option made more sense. The real volatility, though, was playing out in foreign exchange markets. The Canadian dollar initially dipped in the first week of the trade conflict, but stabilized as Brent crude prices rose. However, Ontario and Alberta's slow pullback from US syndication created a technical rift in the USD/CAD market. Some desks began padding liquidity buffers in their overnight reports. A Vancouver commodities trader even noted it was harder to find US dollars after 6 p.m., a restriction not seen since the 1998 Asian financial crisis. Interestingly, these shifts also opened doors for local businesses. A mid-sized solar panel manufacturer in Thunder Bay saw its domestic market share double after tariffs hit Chinese-made panels. But even with the uptick, supply chains remained globally tied. When a copper coil shipment from Shanghai was delayed by 3 weeks, production lines shut down mid-week. The fragility of Canada's domestic gains quickly became clear, especially for small players shouldering the weight of rising inventory and finance costs. Meanwhile, in Alberta's oil and gas corridor, a new momentum was building. The province targeted new loading ports in the Gulf and mapped tanker routes from the Pacific to Asia. This helped diversify Canada's exports and allowed some funding to bypass US banks through European insurance groups. The Brent oil basket also offered a protective buffer for the CAD. Still, when environmental protests spiked risk premiums, European investors hesitated, particularly with projects that clashed with green finance criteria. In this strategic chess game, the US still holds powerful pieces. Though the White House has signaled a softer stance post-Trump, the tax wall still looms over negotiations. Canadian financial planners aren't banking on a full return to the old ways. Even if tariffs are lifted, the push for diversification is here to stay. Swap desks increasingly base their models on the European Central Bank's curve rather than the Fed's. When custodians in London opened sub-accounts for Canadian clients, the message was clear. This wasn't just a detour, it was a permanent shift. Direct capital flows between Canada and the US are still enormous. By the end of 2023, US investments in Canada approached $500 billion, while Canadian holdings in the US neared $1 trillion. But while the base remains strong, the surface is fragile. Like a snow-covered mountain, the deeper layers are solid, but the top layer, warmed by tariffs and nationalist policies, poses an avalanche risk. Most analysts agree that the deep integration between the two economies can't simply be undone. But even a small rise in the risk premium is enough to shorten bond maturities or increase guarantee costs. In Montreal, a building materials company reconsidered opening its new plant in Ohio, opting instead for Saskatchewan, not because of tariffs, but due to financing uncertainty. That same day, a Boston asset manager didn't dump Canadian bonds, but did open a hedge in case the trade war drags on for 5 years. As eyes once again turn towards the Bay Street skyline, the rain has turned to snow. The mud has frozen. Beneath this icy surface, a new financial landscape is emerging. London bankers, Frankfurt brokers, Singapore traders, and Tokyo institutions are quietly reshaping Canada's financial future. Whether you call it a symbolic shift or a strategic pivot, Canada's quiet banking revolution has drawn a bold new line. The dance with the neighbor continues, but the rhythm has changed. As a new day begins on Bay Street, one concern remains in the minds of analysts. If this complex, multi-directional rhythm fails to find harmony, can Canada hold its breath under the ice long enough for new financial pipes to be laid? Or will the cold grip all parties until something breaks? Time will tell. From the Singapore dollar to the British pound, from oil flows to rare earths, new financial veins are being laid. Everyone, whether in Toronto's Granite Towers or Calgary's pumping stations, is watching for the first sign of a blockage. Because finance, like water, always finds a way forward, unless the ice traps it or the pipes burst. What do you think? Share your thoughts in the comments below. And if you want to stay informed on this evolving story, don't forget to subscribe and turn on notifications. Thanks for watching Torch Point.